Welcome to the latest rendition of the latest of my fairly long-running, at least the past several months, series of webinars here at FX Street, charting the course. Thanks to all of you for attending and your prior and participation, and especially thanks to FX Street for making this event possible. First, let me remind you the purpose of this event is education. I'm not going to provide specific trade alerts or recommendations, but we'll take a look back at the trading day that has just unfolded right before our eyes. And we'll take a peek ahead at what the, not just tomorrow, but maybe the coming trading days might bring. Happy New Year to you, Erwin, and everyone else here. Happy New Year. Welcome to 2012. Let's hope it's as good in terms of currency market volatility as it was last year. Now, I don't know, some of you may be thinking that there were times when the volatility was too high. Well, I don't know. Given the choice between put this another way. There were times when, especially in the unwinding of the Japanese yen carry trade, back in especially like 2008, 2009, when volatility was extremely high on those yen crosses. There were days when it seemed like those yens were virtually untradeable. But compared to that, last year, Euro USD, I mean, folks, there's a reason why I produced it was just north of 150 New York session video reviews. I'm not looking for bragging rights amongst the bootcamp coaches, although it's kind of nice that I think I have that. I haven't checked all the numbers for all the bootcamp coaches in prior years, but I don't think any coach, maybe David has come close, and I'll have to check the records, but I don't think any coach has produced that many video reviews for a year. And I'm sure that there's probably other analysts or other so-called currency experts who've produced over time, more videos. So I think of where some have produced them daily. But my point is this: I produced 50% more videos last year in 2011 than the year before, 2010, for a reason. Because there was so much action, enough volatility, and particularly on the Euro USD. As I see it, it made for some great trading, and the spark for that, it goes back to the so-called fundies. This mess in Europe, the sovereign debt concerns in Europe, really a catalyst for a lot of volatility, not just in the currency markets, but in other markets. So I don't know about you, but I say bring it on. More of the same. Would love to have it. I don't wish any ill will on on market volatility and what it can mean for certain people in certain roles at certain companies whose jobs may be affected. But as a trader, bottom line, I want volatility, and uncertainty can bring that. And as I see it, there's still plenty of reasons for uncertainty about not just Europe, but the broader global economy. Anyway, with that, let's take a look at what happened today. I'm going to open up a chart for the euro for starters. I'm going to get to about it's about right there. This shows price action. Oh, you don't see my cursor here. I'm showing price action from about maybe the open of maybe the London Open last Wednesday. Again, I'm roughly guessing this is from since last Wednesday's London session open. You see the sharp sell-off during Wednesday's New York morning session. Eventually, what the euro did last week, I believe we discussed this. The euro has essentially matched its January low. I believe it's January low, represented by the horizontal black line near the bottom of this hourly chart for the Euro USD. And ever since then, by the way, just below that January low was last week's weekly S2 pivot point. So weekly S2 January low, interestingly enough, defined the low last week for the euro. And ever since, it's been a steady grind, more up and down for the euro since then. And today's rally, it's essentially today being the first trading day of the year. The euro has opened the London trading year, you might say, on a positive note. We get the euro rising, breaking above 1.30, the nice round number psychological level. And notice I've got a couple of lines at the top of my chart. The two lines I'm focusing on are the blue line, horizontal blue line, at about 30.58. Now, don't take that number too literally, but I'll explain in a moment where I derived that line from. And the red line. So blue line and red line. The red line happens to be a trend line, specifically a downtrend resistance line, and then you got the blue line. So notice how those overlap. And how the euro, as I move the chart forward a little bit, how the euro flipped from up to down around there. Now that was a viable either scalp short, or anyone who happened to take a euro long sometime during the Asian or early London session, that was a viable profit target. So let's talk about why what's the origins of those two lines, the blue line and the red line. The red has 30.60. Okay. Yeah, I won't object to that. I don't know why. Let me tell you why I had 30. I believe I placed it at 58 based on price action on a 15-minute chart from last Wednesday. Let me go to a 15-minute chart, and let's really zoom in on last Wednesday's price action. Yeah, you could make it 60, and I won't argue with it at all. I mean, just come on, just a couple pips. But you see the lows? I'm showing price action starting last Monday through at least a part of Wednesday. And this is a 15-minute chart for the euro. And I'm using some red arrows to highlight some of the lows, which to me seem to suggest an area of support. Call it 30.60, call it 30.55, whatever. So that's the origin of the blue line. Again, that's price action from early to middle of last week. Now let's get back to more recent price action. I'm going to go to a 4-hour chart. Now in the upper left-hand quadrant of this 4-hour chart, now I've got a couple of red arrows to highlight these. You should see a series of 3 lower highs, starting with the high on December 2nd. So the December 2nd high, a December 8th high, I should say the December 8th high, and the December 9th high. All I've done is to connect those highs with a red trend line and extended that red trend line forward in time. So it seems again, and it seems the 1.3055 to 1.3060 zone put a floor under the euro during about the first half of last week. That was the reason for the blue line and the red trend line based on a series of lower highs established earlier in the early part of December. And simply put, that was the basis for taking profit on a euro long for those who took it in either today's Asian or London session, and the basis for at least a scalp short on the euro. Now we talked about, I should clarify, one of our newest currency coaches, Javier at FX Bootcamp, talked about the prospect of a long on the euro around 1.3015. Let me explain at least a couple of reasons why. First of all, you could apply a fib study of the move up from the London session lows, around 29.75-ish. You got a 50% fib near there, 50% Fibonacci retracement level. That move up, represented by a horizontal black line at about 1.3016. Another way to approach this from a fib study perspective: pick a low, pick actually today's low. Let me see if I can grab onto this. .2% fib plus an early London session high. Was stalling around that 30.15 level, offering an interesting technical setup as well. Let's take a look at that pair. Yeah, KO, I agree. Few pips off doesn't matter. It's the area that matters. But I've encountered plenty of traders that have gotten too specific about support and resistance levels. And I'm sure you do too. I try to encourage everybody to think in terms of zones. Think of support and resistance as like a cushy zone. Even trend line the same way, a kind of a cushy zone. sometimes you can overshoot these levels. Obviously sometimes they break, and then they price response to those same levels or sources of support resistance again later. But I think that the zone analogy or like the fence analogy always helps me too. I think think of a fence surrounding a pasture and and cattle inside the pasture, and like a cow, for example, might poke its head through the openings in a fence, but not being able to get out. So anyway, let me go to the Aussie charts with indicators. Yeah, and like you referred to last some area like see context of and again as the euro dropped to that 30-15 zone, the Aussie was at its 15-minute 21 EMA, also its hourly 5, which are, by the way, the two moving averages very commonly in about the same place. 15-minute 21, hourly 5, often about in the same location. And you can see as you expand out this, if you zoom out on this 15-minute chart for the Aussie, that the 21 EMA was in control earlier today as well. So you see my cursor highlighting how the 15-minute 21 seemed to put a moving floor into the Aussie then as well. And look at what stochastics was doing at the time on the 15-minute chart. I mean, for the traders who like to use stochastics, stochastics was certainly, if anything, buyer friendly at that time. So it was very reasonable to be long in around the 1.0 like 35 area or so. I'm sorry, 1.0335 area. And you see a horizontal, I've got a horizontal gray line near the top of my charter at about 103.85. That's not, well, I guess I could show you that. I could refer to change the time frame on this chart, but the chart I want to show you that I've already got prepared is back in my market overview. And what I'm getting to is the logical profit chart for that long on the Aussie. Yeah, I've actually got a horizontal red line in this other Aussie chart. And I've gone to a daily chart on the Aussie. And you can see in the upper middle part of this chart, let me get the date right, the December 8th high. Again, the December 8th high for the Aussie, represented by the horizontal red line. And that essentially defined, that same level essentially defined the top for today's Aussie rally. So it wasn't much. It wasn't much. In around 35, out around 75, about a 40 pipper. Similar scenario for the Euro rally. Now one could ask, why would one expect that that's all you would get out of the trade, about 30 or 40 pips profit? Well, no, one option obviously was to hold the trade and just let it run. And, maybe you could close the trade at London close. For example, you could have closed the trade around noon New York time, a little more than an hour ago. That was one option, just let it run rather than figure out, what would be a logical target. But certainly in either case, whether it was the Euro USD and closing the trade around that 30-60 zone or the Aussie closing the trade around the December 8th high, either one was very reasonable, especially as both pairs, seem to struggle to establish new highs above those respective resistance levels. And going even further with that thought, why would a trader expect that rallies would fizzle? Well, we're still in a sort of a holiday thin trading mode here. Thin market mode here. I mean, it's the first full trading day of the new year. There's arguably a lot of even plenty of retail traders out in the market, plenty of hedge funds not back in the market yet. So thin market conditions usually mean lower volatility. Actually, you can see just the opposite. If there's with the right catalyst, thin markets can also mean exaggerated moves, but we haven't seen any meaningful catalyst as of yet. Don't know if we can expect any before the end of this week, for example. So what can I say? That was really about it. That was all that the market really offered up in terms of, conservative trades on, some of the, couple of the, in this case, the Aussie and the Euro, a couple of the more liquid currency pairs. And upon, oh yeah, we did see the release of the U.S. ISM Manufacturing Index. The headline number was a little bit higher than the consensus for in the newspapers. We'll talk about maybe the end of the Manufacturing Index report. But, as I see it, suffice to say that we have not seen I haven't seen any lasting meaningful patterns of time here as this new year unfolds. But, it hasn't happened yet, and, really since, especially around like at least mid-year last year, maybe even before then. The market, again, has responded less and less to U.S. economic reports. So I'm assuming more of the same until the market changes. Now, what kind of change could bring about more volatility in response to U.S. reports? Well, what about a trend? A trend in figures such as non-farm payrolls. I mean, if you look at the recent figures for non-farm payrolls, where the headline NFP number is able to print something like roughly 100K or a little bit above that, but we're not getting the kind of a lasting, notable trend in NFP numbers to lead investors and traders alike to believe that there's a significant or lasting recovery in the U.S. economy. So until some U.S. economic data changes enough to stir things up, it's probably going to be more the focus. Maybe it still reside in where things are happening, right? And although seems like we're in a break right now in terms of action or political moves and such in Europe, until the market finds something to focus on, the market will probably still keep us focused to some degree on Europe. And I was telling the live class at FX Bootcamp today that I recall reading or hearing somewhere that French President Sarkozy and German Chancellor Merkel are going to be meeting next Monday. So maybe that's going to be another catalyst for the currency market, what Merkel and Sarkozy come up with, or maybe better yet to say whatever they don't come up with from that meeting. Now, before then, there's going to be other things happening, or maybe other markets that move because that could affect the euro. For example, I'm still keeping an eye on things like the Italian bond market or the Spanish bond market and such, and even to some degree the French bond market. If we see a notable move in, say, the Italian 10-year yield, that might have some rub-off effects on, say, the euro USD. There is some U.S. economic data, but even though we haven't seen the U.S. economic data, as I mentioned a moment ago, move the market much. Maybe a surprise number from one of the upcoming U.S. economic reports. We've got ADP employment report on Thursday, of course, NFP on Friday. Maybe a surprise number. If we get one, will shake and rattle the market a little bit. George, at best guess on that, around the middle of January. Middle of January is pretty common. Some have referred to the Martin Luther King Jr. holiday in the U.S. as a good benchmark for that. It's on a Monday, sometime around mid-January. I mean, don't hold me to that, but that's one example. So, with that in mind, that brings us to, you might say that's a good segue for a discussion about risk management. One thing we talked about in the live class at FX Bootcamp today is the idea of lowering your risk given these thin market conditions. It's not crazy to lower your lot size. Maybe cut your lot size in half or be simply more selective with your trades. I mean, based on history and how the market moves, or I guess maybe I should say the lack of movement historically on pairs like the Euro USD at this time of year, if you're expecting to start the year up in a big way, and this is where trader psychology comes into play. Some of you, some traders are back from taking a break. You're refreshed. You're energized. You're gung ho about the new year, and what's the first thing that people want to do when the new year arrives, no matter what their goal is. If those who are ambitious want to get at it. You want to get going. You want to take action, right? And the most common form of action to a trader is taking trades. But taking a lot of trades may be exactly the wrong thing to do. In fact, it is often the wrong thing to do at this time of year. Now, we had an exception last year, and by the way, this brings me to another point that when it comes to historical patterns of price action on this pair, the Euro USD. We had a case last year where some of you recall it was around the end of 2010. There were concerns about Ireland and even of Portugal. Ireland had to get a bailout in late 2010. There were concerns about Portugal eventually needed a bailout as well, and we were I recall watching things and like Portuguese bond yields. We were talking about this in the live class at Ethics Bootcamp at the time last year, and the euro was under notable pressure, selling pressure, late in late 2010 and early last year. And so volatility was, pretty good, and we had some reasons to be trading that early last year. And what happened, as I recall, this was around mid-January last year. We had a notable turning point. There was 1 week that was a significant turning point week for the Euro USD, or just generally speaking, the euro as a common currency. It was a testimony by then ECB President Jean-Claude Trichet at the European Parliament. He made during one of Trichet's testimonies in Parliament, which all ECB presidents, well, I should say all of the Trichet's been only the second one in history. Now we got Draghi, third one. But the ECB president frequently delivers testimonies, kind of in a central bank update to the European Parliament. And when Trichet did this back in January, the focus of the market primarily was on sovereign debt concerns centering on Spain and even Portugal. While Trichet, in referring to rising eurozone inflation, seemed to shift the market's attention away from the sovereign debt concerns and towards the prospect of an ECB rate hike. So again, what I'm doing is explaining how last January might have been a bit of an exception, given that the sovereign debt concerns in Europe were peaking in early January. Plus, then you had around mid-January the Trichet testimony. But I don't see right now at the moment that those concerns are quite as high. In terms of now, I better select my words more carefully there. We still have the market, at least by measures like the Commitment to Trades report, market's very bearish on the euro right now, very bearish. And you see yields in Italy, for example, still fairly high. But I call it intuition on my part, call it a gut, just a gut feel, but I feel like the market's going to need a trigger to get worse, or to see a notable improvement in say a rally in the euro. And I don't know if we're going to get a catalyst for that until, say, later in the month, when we start seeing some of these governments who've been under the market spotlight, some of these governments try to sell bonds. For example, the next notable Italian bond auction, I think around the third week of January. Yeah, I see Gamma. See your comment about people haven't finished skiing and drinking schnapps yet. Oh, the other point I was going to make with regards to the Euro USD. So, I mentioned a little bit ago, seasonal I guess I call it seasonal patterns. Let me queue up a monthly chart. Yes, I did say monthly chart for the euro. Unfortunately, I don't have this chart properly labeled to illustrate this, but I guess my point is this: take a look at I guess I could probably highlight some of these things. Take a look at the monthly chart, and notice where the euro each year over the past several years established either its high or its low for the year. One example, last year was a classic example of this. The euro establishes, now, don't take me too literally on this, because actually last week the euro just briefly broke below the last January's low. But as I see it, for all practical intents and purposes, the euro basically establishes low for the year. The euro basically establishes 2011 low in January of last year. And it's something we've seen quite commonly over the, I could say this, I should have the exact figures, I don't recall what they are now, but I'd say there's 2 or 3 at most years since the inception of the euro when the euro did not establish either its high for the year or its low for the year in January. Now, don't bet the farm or your house or your favorite goat on that. But it's a common pattern, such that it's something to watch for. And I got to think there's plenty of other traders, including some hedge funds, who recognize that as well. JP, the best place to ask for that coupon, the NFP event hosted by FX Street on Friday. Our chief currency coach, Wayne McDonald, will be conducting his monthly NFP event on Friday. Started at 8:30 a.m. Started at 7:30 a.m. New York time. Ask him. He's in fact, given the start of the new year, and a lot of some of the changes that are about to take place at FX Bootcamp, he may be in a generous giving mood. So JP, ask Wayne McDonald, Chief Currency Coach at FX Bootcamp at Friday's NFP, if you can make it there. Yeah, Gam, I see a comment about war with Iran, and even those are the source of the catalyst in case a geopolitical event that could affect the markets. I've seen, I'm not going to have a whole lot, as much time as I would like to cover these things, but it's something I could do. It's Tuesday, right? I can cover this on Thursday. On Thursday, I can spend more time covering some of the things that could affect the markets over the course of this year. And I guess I'll go ahead and say it now. Thursday may be a good time to do it because I'll say, I'm not going to say forever, but for a while, maybe indefinitely, Thursday will be my last webinar here at FX Street. So for the indefinite future, Thursday will be my last regular scheduled webinar at FX Street. I don't want to go into the reasons why yet. I'll discuss that near the end of this webinar. I want to focus now on talking about, I already talked about what's happened, but I guess we can take a look ahead at what could happen. Yeah, I guess your comment about that could be a longest. Yeah, I've been collecting some topics and some possible catalysts. And there's plenty of stuff, plenty of things. But you know what? As a trader, I love that. Now, it can be disconcerting on some sessions or days or weeks when there's multiple news events affecting the markets. It can make for some tough trading. But I'll tell you what, I'd rather have a market that where there are catalysts, and those catalysts that eventually that materialize, they're going to move the market and provide volatility, as opposed to the kind of humdrum market we lived through back in summer of 2007, where at one point the Euro USD was barely pushing 60 pips per day on average. I'd rather have a more volatile market than not. Because I found, especially last year, what I found interesting about last year is that let's move this to a daily chart. What I found interesting about last year is that even when volatility was relatively high, eventually the euro would get to levels on certain days, certain sessions. Eventually the euro would get to levels where technicals would prevail. In fact, I'm showing a daily chart. Let me go to a weekly chart. And some of you may recall me discussing this before we got there. I've just drawn a trend line connecting the 2010 low with last year's low, and we talked about the prospect of this trend line putting a lid on any euro rally. In one of the FX Street webinars I did before the euro rallied in late October and reached that trend line. So on a day that was just like something like October 27th, on a day when there was arguably a euro short squeeze in place, and this was in response to the late October summit of European leaders, and they came to some sort of deal on Greek bonds, a so-called voluntary 50% haircut, and the euro rallied all day. It was really one of the biggest single-day moves on the euro, and really probably the fourth quarter of last year. And yet that move eventually fizzled in the vicinity of the red trend line you see drawn on this weekly chart for the euro. And what can I say? I mean, you know, some hedge funds, among others, even some retail traders, were just parked around that 142 zone, waiting for the chance to sell the euro on a rally like that. And knowing the history, especially knowing the history of how the euro has responded to past so-called bailout attempts or moves, policy decisions made by European leaders. I mean, we have not seen, especially over the course of much of last year, any lasting rally on the euro in response to some of these summit meetings conducted by European leaders. So let me put this chart back in place. Yeah, I'm just thinking aloud here, and I just heard some commentary from a couple of noted traders in other markets, especially commodity traders, what a lot of them do, on a CNBC a little while ago, and it made me think about this time of year. This is the time of year, whether you're a trader or not, that people like to define goals and make their plans for the years and such. Now, we've talked about this issue before, but I think it's worth bringing up again. I won't repeat everything of all the things I've said on this topic before, but I think it's worth bringing up, especially those who may not have heard the discussion earlier. And that is, I've seen plenty of traders establish goals for themselves, like even daily goals on a number of pips. I've weighed on this before, and I'm going to weigh on it again. I am not a big fan of quotas. Can anyone imagine why? I am not a big fan of daily quotas in terms of pips. I do not like the idea of just rigidly believing that I've got to make like, I don't know, 50 pips today. And all I need is my 50 pips, and I make my 50 pips, I'm done. Exactly, Gam. That's the biggest reason there. It's I shouldn't say that. Okay, I'll give it to you. That's the biggest reason. It's one of the biggest reasons. But I see it as twofold there. You say that's one bigger reason, Gam's response there. When you force yourself to trade when maybe the best position, if you will, is no position. Remember that. In fact, I think I believe at least one of you should tattoo that on your arm or on your have that I love mom thing removed from your arm and then tattoo on your arm instead. A viable position is no position. I don't know, something like that. And by the way, don't go to a tattoo parlor telling them that Curt said that the tattoo does, or don't tell your mom or your significant other or your spouse is going to do that. That's just a joke. My point is this: always remember this, folks. A valid position in sometimes in some markets, depending on the market, depending on your trading style, a valid position is often no position at all. Think about how you spend your time as a trader. At least, those of you don't know, I'll tell you how many of us spend our time as a trader. A lot of time is spent waiting. A lot of time. Well, yeah, there's often you're analyzing the markets. You're looking at charts. If you're monitoring news flow, you're making sense of news flow. If you're really into the so-called fundies, the fundamentals, the economic fundamentals, maybe you're doing some of your own research, looking at economic data. Reviewing things like, meeting minutes from central banks and such, trying to make sense of things. What's the next move by certain central banks? What's the next move by politicians? What economy tends to be growing faster than others? You can look at all sorts of economic and either political data or such to try to make sense of, what could happen before it actually materializes on the charts in terms of price action. But now where was I going to go with that? So I was talking about what viable position is no position. Oh, in terms of in terms of how you spend your time, but day in and day out, or session in and session out, you may find that a lot of your time is if you let it be that big draw on your time, a lot of your time can be spent staring at charts. Here's what I tend to do. I will even while I'm coaching at FX Bootcamp, I'll glance at charts. Look for see where things are. Look at longer-term charts, look at short-term charts, watch indicators, whatever. I may establish a trade plan, or I may decide that I see no trade plan now. I'm waiting. Maybe I'm waiting for something to happen, or maybe if I'm bear, I'm waiting for a price to rise, or if I'm a bull, I'm waiting for a price to drop so I can buy on a dip, for example. But while I'm waiting, I'm not always staring at price action. I'm reading reports. I'm monitoring news. I'm doing something else. Maybe even something for my a personal task, or something that unrelated to trading, just to pass the time. And I still sense it at our FX Bootcamp that there's still a lot of people who just stare at charts. Folks, that's not number one. That's not a very good use of your time. And I think every one of you should treat your time as incredibly valuable, no matter what the level of funds it is in your account. And number two, there are tools you can use on plenty of platforms that can alert you to when things change. Let's say, for example, you've established that range that maybe the euro is trading in a 30-pip range, and maybe you decide that you're not going to do anything with the euro until it breaks out of that 30-pip range. Well, put a couple alarms in place. Put an alarm just above the top of the range. Put another alarm just below the bottom of the range, and let the alarms tell you when something happens. And until something happens, you're doing something completely different. Maybe it's playing video games. I'm not a big video game guy, but I can see why. I can see how for some people that's a valid form of not only entertainment, but also a valid way to keep your skills sharp. I know actually a couple of currency coaches that play video games in their spare time. I got to think if anything, it helps hand-eye coordination and keeps your mind sharp, because you're taking in, and when it comes to video games, you're taking in so much stimulus, so many inputs, and you're if you're in sort of a war game, you're pulling the trigger all the time, right? So you're getting all this practice on pulling the trigger. Myself, I don't do that as much. There's more to read in terms of fundamentals, in terms of reports and data to sift through than I have time for. So there's always something I can dig into, always a correlation study I can run, always something to read, something to grasp. History of the Great Depression, which I've been reading some over the past few days. Always something, and even sometimes I'll read something I've read before just as a refresher. Yeah, see, George, just your comment about the market doesn't always go the way you expect it to. Absolutely true. So to finish this point, actually before I finish the point, I'll answer the latest question about FOMC. You're referring to, I presume, to the release of the FOMC meeting minutes, which what time is that? Top of the hour. Well, here's my thinking about FOMC, and I'll finish this thought thread, if you will, about how to spend your time. I know that this year, I have a graphic on this. You know what? I'm going to make my note myself. There's two things I want to bring to the table on Thursday. On Thursday's webinar. Number one is the list of potential catalysts or concerns, if you will, for this year. I'm writing this down on a post-it note so I remember. The second is the new makeup of the FOMC voting members. I've got somewhere, I think it was on my laptop, a graphic that someone produced that I caught online. So here's my point with FOMC. I don't know how much. First of all, I don't expect the FOMC meeting minutes today to have much of a lasting effect, unless there's some notable surprises. And even then, if there's any if there's any notable clues in the FOMC meeting minutes from let me back up a bit. The FOMC, that stands for the Federal Open Market Committee. The Federal Open Market Committee is the group of people representing the Federal Reserve, that's the U.S. Central Bank. It's the group of people who decide on behalf of the Federal Reserve monetary policy. And they've made decisions on, whether to raise or lower the Fed funds rate. And recently they've made decisions like, launching the so-called quantitative easing programs, QE1, QE2, and if anything, right now there's speculation about could they launch QE3? Could QE3 be in store? The answer to that, I don't suspect, given the voting members that were in place late last year, specifically at last month's meeting, I don't expect you're going to see, if I had to guess, you're not going to see a whole lot of clues about QE3 forthcoming, given the voting members there. Because what happens is every year, at the start of the new year, we see some members who had voting status at the FOMC will lose their voting status. Other members who did not have voting status last year will attain voting status. And then there's a core group like Bernanke is one, for example. I believe William Dudley another. A core group of FOMC members who always have voting status. But my point is this: there's going to be a notable change in the guard, if you will, at the FOMC starting at this next meeting. At this next meeting, you're going to have far fewer so-called hawks and more doves in place. And I suspect if the FOMC decides to launch QE3, first of all, you have to see some the economic situation, particularly in the U.S. or maybe even to some degree in Europe, get notably worse to justify it. But given that, if that does happen, if the situation does deteriorate notably, then you have more so this year than last year the kind of voting cast in place that would be more willing to agree to and approve a QE3 program. So last year had some notable hawks in place. Plosser was one from the Philadelphia Fed, Coker Lakota, I don't know how the last name's pronounced, from the Minneapolis Fed was there. Richard Fisher at the Dallas Fed was there. These guys did not want to do QE3. In fact, they didn't even want to alter the extended period language when it comes to the Fed funds rate, which was that was altered in August of last year. So those guys are gone. Those so-called hawks, the ones who are concerned about future inflation, the ones who don't want to see anything like QE3 launched, those guys are gone. So the voting members are in place now, at least more inclined or probably more open to further easing measures. Yeah, so Jack nails it. I mean, that's what I'm getting at. My point is this: I don't expect to see much hint of that this time, but let's face it, the market likes to anticipate these things in advance. So if the market catches any whiff of a cracked door, a door which could be opened to its way to QE3, then it could respond to it. But if I had to guess, you're not going to see any meaningful hints from the last meeting and the meeting minutes about to release 15 minutes from now. I don't expect any meaningful hints from that. If we're going to see the Fed move closer to QE3, it's going to happen. I guess one of the next two meetings, where you'll see more meaningful discussion about further easing. Yes, George, essentially. And that may not involve acquisition of Treasury securities, which has been one of the more recent ways in which one of the recent modes of quantitative easing. It may involve more support of the housing market through purchase of mortgage-backed securities. So again, that's my guess too. I think they will do what they'll pitch in if needed to help Europe, and I guess that's about it. I mean, look at the classic measures of, what would dictate what the Fed will do. I mean, inflation, for example, it's certainly higher than it was the last time we saw quantitative easing now. So I think we're just going to step pat for a while. My best guess, folks, I still think and when it comes to next policy moves, it's probably going to come from Europe, and maybe specifically the ECB. Let's see if I missed anything else. Some of your prior comments. Yeah, Jack, I see your comment about U.S. defense budget and such. Oh, boy, election year. What can I say? I feel like I never did quite finish the line of thought with regards to trader psychology. So what I was getting back to, I was trying to finally circle around to the idea of a quota. I've never been a fan of the quota system. The idea of I've got to make what I do agree with is this. I like the idea of any trader who seeks for a given currency pair, for example, a rough number of pips on average per day. I think of it like a moving average. I'm okay with that. I'm okay with traders who trade, like, say, predominantly the Euro USD, for example, and who seek to make a overall running average over the course of days and weeks, an average number of pips. Now, keep in mind the average daily range of various currency pairs changes over time. I mean, for example, was more like 4 years ago, almost 5 years ago now, 4.5 years ago. 4.5 years ago, summer 2007, if you making like 20 pips on the euro was arguably a pretty good haul for a given coaching session. I mean, those were days when the euro was moving 60, 70 pips a day on average. But yet there are other days, other months, other quarters, for example, where if you earn only 20 pips a day, maybe you're not doing enough. You could be missing some big moves. And I guess here's the other point I wanted to make when it came to quotas. The thing I find is maybe the word isn't discouraging, but the thing I find that can misguide traders when it comes to quotas. Quotas can work against you in two ways. As Gam said earlier. Gam said earlier. Either A, you inherently force yourself to trade at times when you shouldn't trade, or B, what happens is that you force yourself because you've met your quota to end the trade when the market's in the process of producing a big move. And from my perspective, you know what? More and more traders, as I deal with traders, more and more traders need to let more trades run. Cut the losers loose quickly, and let the winners run. Now you got to recognize the market and recognize any news that may be driving the market on a given day. And then there's some days when your best strategy is to take the pips when you can get them and scalp away through the market. But other days when there's news flow and they're just we see a lot more green than red, or vice versa, a lot more red than green, and you need to let some trades run. And key over time is to recognize which market you're in and trade accordingly. George, actually, I'm not. I'm actually not. George, and I it's probably the way I explained it that I didn't make myself clear enough. George, here's what I do. And I'm already running past my time, and my apologies to anyone at Epic Street who's still here right now. And I'll end this pretty quickly. Actually, I'm gonna make this a third point. I'll discuss this, and let me give me another talking point for Thursday's webinar. The keyword I'm writing now is metrics, trader metrics. George, my focus as a trader, my focus personally is the process of trading. I believe traders should measure not outcomes like pips. Well, let me qualify that. It's okay to measure outcomes, but I don't measure my performance as a trader strictly by outcomes, by the number of pips I earned. I mean, think about this, George. In some days, a 30 pip trade on the euro is great stuff. You may have captured on a given session, if you trade predominantly one session, you may have captured the move, the big move, the entire move on the euro. On other days, if you only capture 30 pips of a move, you have left pips on the table. You have cut a trade short or something, or gotten a stop triggered when you should have let the trade room to run. Something you did something that you many times maybe you shouldn't have done. So here's what I focus on. I focus on metrics that measure how effective I am at reading the market, how effective I am at managing a trade, how effective I am at entries. And I admit some of those metrics can be subjective. But my point is this: focus more on the process, not the outcome. Focus on the process, or should I say processes. Focus on the process involved in trading, not the outcome. And again, I hate leaving you with that because you're like, well, what do you mean by that? I promise you, I will make time to get more into that on Thursday, during my webinar on Thursday. Examples of things you can measure to assess the effectiveness of your process of trading. And George, again, it may not be the answer you like to hear or want to hear, expected to hear, but you know, I tend to, when it comes to issues like this, I tend to go back to one thought, one concept. You got to read the market. You've got to read the market. You've got to learn to recognize over time when it's and again, we're all wrong about this at times. Nobody's perfect about this all the time. By no means. Certainly, I'm not. But you've got to improve your odds, improve your percentages, improve your performance over time by how well you can recognize when there's recognizing when a market that's trending, that's moving, versus the market that's not, and trade accordingly. Also got to recognize when your trading style and trade accordingly. You know, if your trading style suits the market, you should be killing it, or at least do it, or bring your A game and do your best to kill it, to do very well. If the market is moving in a fashion not conducive to your natural trading style, you should be more selective about your trades. Maybe sometimes you should step aside entirely and not trade. You should not be forcing it. If you're a scalper and we're getting big, and I've already said enough, so I need to wrap this up. Folks, have a great day. Thank you very much for joining us. We'll do this again Thursday. Thursday will mark my last, at least for a while, my last webinar at FX Street. Thanks to all of you for attending today, and for your participation today. And we'll do this one more time on Thursday. Oh, and by the way, really quick mention, and thank you, by the way, Ani, for posting that down there about my webinar here today. I'll talk really briefly on Thursday about some of the changes going on at FX Bootcamp and the reasons why I'm going to have to end my webinars for now. We got some interesting changes going on at FX Bootcamp, and hope that some of you will pay us a visit over time to see what's going on in the bootcamp these days. Folks, have a great day. Good luck moving forward. Cheers.